welcome to the latest Aubrey Bite. I'm John Muir, and I'm joined today by my colleague Rob Brewis, one of Aubrey's fund managers. Hi, Rob.
Morning, John.
Rob, you've written a couple of papers lately focusing on China for the benefit of our emerging markets clients and prospective clients. Your first piece, entitled China, the Wood from the Trees, attracted some attention and provoked some feedback, which is always good. Before looking at the main issues that the article raised, maybe we could look at the central theme of the article, and that is the sentiment towards China. And we accept that sentiment towards China and Chinese stocks is at a low ebb at the moment, and we understand the reasons for this. But the article goes on to explain that much of this is already, what we would say, in the price, or pretty close to it. Could you maybe speak to that in some detail, Rob, particularly with regards to the valuation side of things, and why we believe that 2022 might be a better year for Chinese stocks than 2021?
Yeah, sure. Certainly. I think that the first thing to remember is just a little bit of background, and that China had a fantastic year in 2020, while the rest of the world was locking down in COVID. Actually, China did pretty well, and the stock market did very well. Particularly some of our investments that were on the sort of more online side of things. Obviously, as people stayed at home, played games, ordered stuff online, they did very well. Yeah. So you're starting from a very high base. So 2021 was always going to be a bit of a challenge. If you look at something like Tencent, market bellwether, it's been a 20% grower for the last few years. It's a very solid business. It grew 28% in 2020. Not surprisingly, a bit of a slowdown in 2021. I think the interesting thing now is that, obviously the regulatory impact has some part to play in that. But what's happened now is, we're back on track for a sort of 20% growth again, but the base has been reset much lower. It's trading at about 1 times PEG, which looks very attractive. Another example, which actually is really of a sort of more of a sort of classic growth stock that's grown all the way through the time is Li Ning, the athletic shoe maker. And Li Ning actually had a fantastic year last year, but it's still expected to grow about 30% for the next 2 years. And again, it's corrected quite a lot in the last few months, and it's again back to about 1 times PEG. So overall, the AGM China portfolio is about as cheap as it's ever been.
All right. Good, encouraging. Thanks, Rob. The follow-up article, entitled Chinese Shape-Shifting, Rectangles Turning to Circles, it touched on specifics, and those were business regulation, the property sector, and the economy. Could you maybe give us an overview of each of these and the part they've played in the current de-rating of the Chinese market, Rob?
Yeah, no, sure. I think those are the sort of the hot topics, the worries that people have. And I think the first one, the business regulation, we feel that the rhetoric is really improving there. And it's still ongoing, but the word from Beijing is much more, look what we've achieved by attacking these monopolies and so on. And other little sort of pieces. For example, the much maligned VIEs, the variable interest entities that many of these offshore listings use, were actually legitimized in the last few months by some regulation, which is the first time ever, and we've been investing in these companies for 15 years. So that sort of thing means to us that I think we're through the worst, and again, a lot of what's been done has been reflected in share prices already. The second point you raise is the property market, which people are understandably concerned about, with Evergrande and some of the others running into financial trouble. I think the important thing is we still feel that there isn't an imminent collapse coming, and confidence is soft in the property markets, but it's not collapsing. People aren't panicking, and actually you've seen some return to purchasing property recently. But the bigger issue really is that the market has discounted it. When you look at the valuation of some of these big property companies that are in trouble, effectively the equity has been marked to zero or very little. Perhaps option value. Whereas the strong are still fine, but that's because they're in good shape. So I think again, probably no more bad surprises coming out of there. And then finally, the economy. Well, yes, I mean, the economy is slowing down, and consumer sentiment is understandably not very strong. And there's a lot of COVID mini lockdowns going on in China, and there's still a lot of restrictions. But if you look at things like exports, exports have been booming in China for 2 years now. Firstly, it was all the PPE equipment and the gym equipment that you needed, John. But now
you noticed, Robert.
Yeah, now it's things like solar panels, batteries, electric vehicles, all these things that we now need to improve our environment. They're all coming from China. And what that means is that externally, China's economy is in good shape. Its currency is pretty strong, and it allows them to ease. And I think they will ease. They can and will ease over the next few quarters.
Quite positive. So, taking all of these factors into account, Rob, and the way the portfolio is positioned at the moment, do you think it might be said that this is a good time to consider going in? Is this a relatively cheap entry point for the portfolio?
Yeah, absolutely. I mean, we haven't really talked about India today, but that's a big part of our portfolio, and we're very optimistic about India, and that's perhaps for another day. China, we've mentioned, is the other big area. It's beaten up, looks extremely cheap, and we're still finding interesting companies there. And then the final point I would say is that some of the real proper growth companies that we've invested in over the last few years that have continued to grow have had a real de-rating in the last few months. So historically, that would suggest that this is a very good time to look at the fund.
Excellent. I was rather hoping you could say that. Thanks for that, Rob. And to our viewers, thank you for joining us. Please contact us in the usual way for more information. And with that, until next time, goodbye.
Goodbye.